Welcome everybody to today's webinar. I'm Devin Walsh, managing partner at StatonWalsh, and today we're going to be talking about politics and your portfolio. We have a big election coming up, and everything is seems 50-50. So today we kind of just want to discuss how that will affect your portfolio and the ramifications this election might have on it. I'm joined today by my business partner, Ryan Staton, who's going to take it over from here. Ryan?
Awesome. Thank you, Devin. And thanks everyone for dialing in and taking a listen today. We're excited to put this on because we think that something that's come up in conversation a whole lot with the clients that we're working with, and we wanted to put out some additional education information. Our goal today is just to focus on the data, see where the data takes us in terms of making decisions about investing long term, and as well as over the next few months as we navigate this election. And obviously, it's a topic that's highly contentious. We're gonna keep it completely objective here today, and we're gonna talk about trends. We're gonna talk about data and statistics, and from there, we hope that everyone gets something valuable out of this. And we'll share some walk away tips or key takeaways at the end, and also share some tools and resources that we're going to make available to everyone dialing in and those that listen to this, the recorded version of this call later. So thanks again for being with us, and we're going to kick it off. This conversation is one that didn't start just recently. According to this chart, U.S. political uncertainty ahead of the 2020 election has been on the minds of investors since this time last year. You can see there, this chart is dated 10/30/2019. So this is this time last year, what investors were concerned about. So we're going to talk a little bit about history, and we're going to talk about what, the trends are telling us moving into this particular election, and start to figure out, what we can do as advisors and what you can do as investors to better position yourself for long-term success. So the big question is, who's going to occupy this house? It's a nice picture of the White House. Who is going to be the president of the United States for the next 4 years? And that's a question that not anyone can definitively answer at this point. And we think that that's a decision that definitely won't be made on an election night. But ultimately, whoever occupies that house, many investors are concerned, what's that going to mean for my investment portfolio? Is it going to go up? Is it going to go down? And so where we think the logical step to start is we're going to talk about people that have occupied that house before Donald Trump and before potentially Joe Biden. So we're going to take it all the way back to 1945, Harry S. Truman. So, Democratic candidate, won office in 1945. At the bottom of the screen, you're going to see economic expansions, recessions, and debt to GDP percentages. So that's going to be an indication to us. Those are going to be economic indicators. And we're going to show you that compared to, maybe talk a little bit about some presidential policies, some other things that were in effect, some other things that happened around the world during these different presidencies, and ultimately try to come to a decision on what actually happened with the market during those periods of time. So with Truman, during his 2 terms in office, the first term, his first 4-year term, cumulative was 35.1%. The second was 128.4%. So really good positive outcomes from a market perspective during the Truman presidency. Now let's shift to a Republican candidate. Dwight Eisenhower takes office in 1953 to 1961. You can see there again, 2 economic expansions, 3 recessions, debt to GDP, 54%. So what happens during the Eisenhower administration? Well, in his first term, there's 111%. So carrying on some of that market momentum from Truman, the Truman administration, and continuing on. And then the second term, cumulatively, 43.7%. So you can start to see the trend that over long enough periods of time, over these 4-year periods for both presidents in both terms, we see a positive outcome in the market. So let's keep this ball rolling and go to JFK. 1961 and 1963. I think everyone in the United States knows what happened in 1963, the tragic assassination of JFK, and creating obviously that was a major catastrophe, but also created some turmoil outside of just presidential elections, but a lot of other things going on in the world with that. And so we look at the economic indicators, but we're also taking into account, obviously, a pretty major event in U.S. history. So what happened during JFK's time in office? Well, 34.7% cumulative rate of return. So still positive, still pretty good. What we wanted to keep an eye on when we're looking at this data is, well, now, obviously his presidency ended with his unfortunate assassination. What happens to the market after that? We transition to the Johnson era. No economic expansions or recessions. Debt to GDP is 39%. But what we see in the market is actually a cumulative net positive return. So still a Democrat in office, obviously a lot of turmoil in the United States. There's some other things that happened during the Johnson administration. We'll talk about, wars and other things, that happened, a lot of changes around the world. And so what we're seeing here is turmoil in the United States, turmoil abroad. Prices in the market have adapted and changed to a degree that the market actually ended up positive in both of those terms. Now transitioning political parties again and going back to a Republican candidate with Richard Nixon taking office in 1969. You'll see there was one economic expansion. There was a couple of recessions, a couple other economic indicators or economic outcomes during the Nixon administration, leading up to 1974, a really bad year for the market. Also stagflation, rations leading up, getting into high inflation, hyperinflation there. So the 70s was a decade that was wrought with a lot of different things, not just who is the president of the United States, but there was a lot of things that, the person in that office as well as Congress had to deal with. So, the first cumulative term was pretty good for Nixon, 28.7. However, the second leading up to that 1974 period in the market obviously did not bode well for him, and ultimately an eventual exit from office. But when he left, the cumulative return was negative 29%. Then bring on Gerald Ford. We have an economic expansion, so coming back from some of those things that we mentioned, debt to GDP at 34%. You could see the market was pretty positive there in a couple different years. So ultimately, what that leads to is a net cumulative return of 50.4%. So still pretty good. And now we transition 1977 and 1981. The Jimmy Carter administration, which, from a public point of view is probably not viewed in the most positive light. I think a lot of people agree that, and if you ever look at a survey on the Carter administration and look at how he's viewed by the public in terms of popularity, not just popularity, but I guess in terms of weighting the effectiveness in that job, it's not always the most positive. However, we were curious to see with all of that, taking all that into consideration, what happened in the market. Well, it appears here that the cumulative market return was 55.5%. So all things considered, had we asked higher or lower with the Jimmy Carter administration, consensus we feel would probably most people would have said, the market was definitely lower, but the exact opposite was actually true. Now we have Ronald Reagan. And from 1981 to 1989, you'll see all our economic indicators there, our expansions, recessions, debt to GDP. The Reagan administration, you'll see in the chart on the right, there's some up, there's some down, but ultimately what happened over the course of his administration? During his first term, 50%, second term, 98.2. So really strong years in the market during the Reagan administration. So then we transition to George H.W. Bush from 1989 to 1993, And, the big push for George Bush was no new taxes, read my lips. We saw an economic expansion, a recession, debt to GDP. Unfortunately, that promise to the American people probably ended up being his downfall. He only served one term. And ultimately, during that term, he had a cumulative market return of 72.7%. So still really positive, from Reagan to Bush. And so now, interestingly, we're going to shift to the Bill Clinton administration. And really, what we're looking for here is we have a long-term Republican president sitting in the White House, and now we're transitioning to a Democratic nominee winning the election. So what is that going to mean for the market? And economic expansions during the Clinton presidency were zero, recession zero, debt to GDP 55%. The other thing to take into consideration during the Clinton administration, the highly publicized scandal, big party change, a lot going on there. So, interestingly enough, when we look at what did the market do during the Clinton administration, first year, 98.8%. So really good. Second term, first term, 98.8, second term, 83%. So also pretty strong. The no economic expansions to speak of and no recessions, but the market did return quite a bit. As many remember, in the 90s, there was the tech boom. There was a lot going on there in the stock market. And so as we transition in 2001 to the Bush presidency, we'll see some of the effects of that. George W. Bush inherited a few things with the market. That tech bubble eventually burst in the first 3 years of the 2000s, 2000, 2001, 2002. Down years in the market, so obviously dragging down some of the long-term cumulative return. 2001, as many remember, there was 9/11 that entered into a lot of activity, military activity overseas for the United States, war in Afghanistan, eventually Iraq. And so with that, we see debt to GDP go to 68%, but also we saw some fluctuations in the market. From an S&P 500 perspective, it was considered the lost decade. 2000 to 2009, the S&P 500, which is what this measure is based on, was flat. Important to note, if you were globally diversified during this time, you probably didn't experience returns like the ones you're going to see. And so for the Bush administration, you have that first term cumulative return down 6.6%. So, the first couple of years of that were including some pretty heavy down years in the market due to the tech bubble. Did have a comeback there, but ultimately with 2008 and 2009 and the Great Recession drawing the S&P 500 down, another almost 40%, that brought down the cumulative return as well. So over the Bush administration, really the only one that we talk about here today that had a totally negative market return during their presidency. Transition to Barack Obama in 2009, economic expansion coming out of the Great Recession. Debt to GDP jumps to 104%. Part of that, the bailouts, TARP, some of the things that happened as a result to the Great Recession. And you'll see there's some up and downs there in the market during the Obama administration, but ultimately the cumulative returns end up being 44% for his first term, second term, 66.4. So all things considered and all the political turmoil that's occurred, and even in recent history as we transition to a Donald Trump presidency, the market has really responded positively to different administrations, different compositions of Congress. All things considered, long-term investors have really been rewarded for their discipline and their patience in the market. Talking about the current Trump administration, there's a recession. With a recession built in there, obviously from everything that happened earlier this year with Corona. This chart is reflective of up until July 8th. So it's not going to take into account some of the more recent months in the market. But as you can see, all the indicators are reflected there. Debt to GDP, 131%. And during his first term so far in office, the market has returned 51.5% to investors cumulatively. So that leads us into our next phase, which is, okay, so what's next? We've seen what the first part of a Trump presidency has meant from a market perspective. Will that continue into a second term? And will the outcome of the election directly result in a greater return in one candidate versus the other? What we will say is that any person on either side of the aisle that looks at this picture is probably, has some cause for concern, meaning that they see something wrong with the other and they're going to vote based on that. And What we want to really address today is let's talk about the effect of either one of these candidates being elected on your portfolio specifically. And getting into the conversation of, well, if this person wins, we think this is going to happen versus that person winning. So let's peel back the curtain on that and just look at all of those individual presidencies over time and look at the trend in the S&P 500 from January of 1926 up until December of last year, so the end of last year. And so what we can see here, it's pretty obvious based on this chart that the market is going up throughout all of those periods of time in some way, shape, or form. We talked about that in individual presidencies, but just painting, a broad stroke approach to this conversation, what we can see is that long-term investors are rewarded for, again, discipline, sticking to their guns in terms of how they want to invest over time. And ultimately, if you got invested and stayed invested during that period, you fared well. There were certainly periods of turmoil and periods of downturn, and there's tons of reasons why. There's all kinds of data to support and to explain why that may have been at those periods of time, but you'll see that the market has generally recovered and made its way back up on its trajectory and growth. So the question we always get, though, is, okay, well, that you're talking about the presidents. What about Congress? What if it's split? What if there's total control? So there's another graphic that goes well with this one that addresses that. Republican, as you can see there's Republican, whether that's the president and Congress together, Democrat, all the same party, or a mixed. So you can see in recent history, we've had a couple instances of mixed, and we've seen obviously from the trough, the bottom of the market, 2019 to its peak, that market has run up 400%. And during that time, we've seen a mixed presidency and mixed House and Congress. We've also seen all Republican, and then we've seen mixed again. So with that, what we're ultimately what we're getting at here is, again, long-term investors are rewarded for picking a disciplined approach, getting invested, staying invested, and not letting the emotions of political parties overcome their investment decisions, wholeheartedly. So that's the logical conversation that we have, but ultimately, we're all human beings and we're emotional, and money is an emotional topic. So we want to talk a little bit about the trends and what's actually happened. A lot of people have seen those charts and they'll speak to investing as a long-term game. But what we've seen traditionally is that investors actually take the opposite approach. And we use this chart, which measures average net fund flows during a presidential term, to look at, is money being invested in equity markets, or is it being repositioned or reallocated to cash and money market funds? So as you can see here, based on presidential terms from 1992 to 2019, investors really start to shift as they lead up to that presidential election year out of the equity markets. They still put some money in equity markets, but they really dedicate a lot of time and effort and money to money markets, to putting money on the sidelines to wait and see what's going to happen. What's next? I want to see who gets elected and how that's going to affect my portfolio. So one of the reasons that investors tend to lean that way is that they're worried about volatility, right? They're concerned about ups and downs in the market, big swings that could affect their rates of return, long term. Now, we've gone through a couple instances where that may not be necessarily an issue through different presidential administrations, different periods of time when we look at terms. But one of the things we wanted to measure and stack up is, does that ideology match up? Are elections directly related to more volatility in those years? And so traditionally from 1964 to 2019, the S&P 500 volatility is 15.7%. So what is it leading up to a presidential election? 100 days prior to a presidential election, volatility is 13.8%. So it's actually slightly lower. And what one might say is, well, okay, that makes sense. It's not really volatile leading up to the election. The volatility really comes into play post-election, once we see our results. And so what the data actually shows us is it's the exact same. So what's the conclusion that we can come to based on what we're seeing in front of us today? Ultimately, what it says there, markets tend to ignore elections. Markets care about elections to a degree temporarily, but long term, and even in some of the shorter periods of volatility, markets don't really tend to care very much about elections. And so what that does is that shows us that some of our fear may be founded on some of our own personal beliefs and not necessarily on the data. And that's perfectly fine. What we're here to do is provide information and to make sure that everyone out there understands that, one, how markets work, two, that long-term investing is key to success and key to performance in a portfolio, and that ultimately we want to make sure that investor behavior is directly related to the outcomes that you want to achieve. So let's dive into investor behavior a little bit and talk about the outcomes that can be achieved from an investor based on the decisions that they choose to make when it comes to market investing. So here we're looking at 3 investor strategies during an election year. We're looking at 22 election cycles since 1932. And those 3 options are: we can fully invest. We'll take your $10,000, put it in the market January 1, and ride it out for the election year and beyond. So we're going to look at 4 years post-election to see what the performance of that money does. We can do consistent contributions, which is basically taking your $10,000 and dividing it into 10 equal increments of $1,000 over 10 months leading up to the election. And the last option is we're just going to sit this one out, hang out on the sidelines, kind of nervous about what markets are going to do. And so I'm going to wait till January 1 of the following year and then hold on to it for 4 years and put all of my 10,000 in at that time. So let's start with that option. If I were to do that and put my $10,000 into the market, at that period of time, after that 4-year holding period, my portfolio would have grown to $14,914. So you see that there's growth there. So it's going back to the data we shared about, terms and how the cumulative rates of returns work there. Had I consistently invested over the course of the election year, so not waited on the sidelines, taken my $1,000 and put it in 10 equal increments, my money would have actually grown to $15,729. The last option is fully invested. Don't skip any days in the market, get all of my money in today and let it start going to work for me. And what we see is that outcome is slightly better. It's only about a little more than $100 compared to option 2 when we talk about dollars and cents in this type of scenario. But the really important thing to understand is when we look at the bottom of the chart, the difference between sitting on the sidelines and getting fully invested and getting right in right away, the difference doesn't seem that drastic. It's a little less than $1,000. But when we break it down in terms of percentages, it's over 6%. So why is that important? In any given year, 6% may or not make or break you. But over the long term, our behavior and the data has shown us from our previous chart that as people get closer to elections, they start to disrupt or unseat their old investment philosophy and replace it with something else. And that's because the voice in our head is telling us something's coming. There's an election. We have to be cautious. We want to be risk averse. We don't want to take any unneeded risk. We're not sure if our candidate's going to win or not. And so we're compelled to make decisions based on that emotional trigger in our head. But, the data is telling us that if I just jump in and get my money invested, long term, I'm going to be rewarded for that to the tune of 6%. Now, multiply that out over many election cycles, that 6% can add up. And right now we're talking about 10,000. We can start adding zeros to this equation, and you can really see how decisions like this could be impactful over the long term. So as we start to land the plane and talk about key takeaways from this presentation, really number one, first and foremost, we don't want you to try to predict future outcomes based on current news. We saw how that worked in 2016, and we're actually going to share a clip with you on election night from 2016 with an asset manager, or an employee of a large investment manager that put out a notice saying what they thought would happen if Donald Trump won the presidency. And then we'll show you another clip that what actually happened. So the point in all this is saying we can't really accurately predict the future, even 24 hours away. So I want to play those clips for you and allow you to get the opportunity to see that and just digest that information and take that away with you to say, we don't really know what tomorrow brings, and today's news is important, but it's not necessarily an indication of what's going to happen in the market, for the next year, 5 years, 10 years, 20 years.
Markets responding dramatically, as we've been discussing, to the current lead by Donald Trump in the Electoral College count. I want to bring Bloomberg's Joe Weisenthal and Guy Johnson, along with RBC Capital Markets Chief U.S. Market Strategist Jonathan Dollop. Jonathan, we were talking a few moments ago before that news came in from Florida, just about the degree to which the market may have priced in a Hillary Clinton victory. Your reaction to what we've seen so far tonight?
Well, obviously the news is a shock, and all evening, instead of watching, obviously I'm watching the electoral map, but I'm watching the, what the market is doing. I'm watching the S&P. I'm watching the Mexican peso, and it's telling me what the odds of a Trump victory is. We put out a note today saying if Trump wins over the next couple of days, it's a 10 to 12% market pullback.
10 to 12% is what they were predicting. So what actually happened, post election being decided, Donald Trump is the president. What happened in the market? So let's take a look at that clip.
We are closely tracking Wall Street's reaction to Donald Trump winning the White House. Dow Jones futures tanked on election night going into Wednesday morning, but then the Dow closed up 250 points yesterday, and today the Dow surged to a new record high at one point, and right now it is currently up over 200 points.
So up 200 points and up to a new record high post-election results. So, we went from, and partially this is obviously one person or one company's prediction, but we go from, the market's going to pull back, it's going to crash, we're going to have 10 to 12% down to now we have a bump in the opposite direction and hitting new all-time highs. So it's just important to know that. And really that takes us, and that's a really good segue and transition to takeaway two, which is avoid mixing political party preference with the success of your portfolio. Why is this important? We put the chart back up there to show you different political parties, the mix of Congress and the president at various points in time. And again, the trend still held true in the past that regardless of that, the market figures out a way. The beautiful thing about free markets and one of the better sides of capitalism is that, administrations put in policies, and what the free market does is they figure out a way to thrive under those policies. Some businesses aren't able to, some businesses have to go out of business, some have to reinvent themselves, whatever it may be. But ultimately what we're seeing in the market is innovation, adaptation, where companies are still remaining profitable. They're passing that down to their investor in the form of growth and dividends and other things in the market. So none of that is necessarily over the long term directly related to a political party. It's really just about long-term growth of business. There have been changes over time, and there have been, things that have happened in the short term. But when we expand a year, 3 months, 6 months, a year, and expand that out to a full term, 2 cumulative terms, what we see is that there have been positive outcomes for the market, the S&P 500 as a whole. And so that's important to understand. And that really doesn't have much to do with the political party. That just has to do with disciplined investing and finding the right place to invest your money. The third key takeaway is individual investor behavior is more likely to affect investment outcomes than any election. So this graphic is a really cool, simple, easy way to view this. Investment return does not always equal investor return. So why is that? The S&P 500 does one number, but the investor doesn't get the same. And we have these conversations all the time with clients. I saw this, did that, but I only did this. So there's a couple different reasons why. Some of it is maybe you're not in the right investments. The other is, poor investor behavior. So we are risk averse human beings. We're biologically really not wired to be able to handle the market. It is a foreign thing to us, and our brains always lean to the side of emotion and making emotional decisions instead of logical. So what that does is it creates a behavior gap, and that's a gap in your investment performance. And what we want to let people know is don't necessarily play into something that you're hearing in the news and the media and you yourself as an individual investor need to do what's best for you from an investment perspective. And so that's going to be taking a comprehensive approach to looking at your individual situation and not listening to any of the outside noise. So a really good graphic that brings that point home is JP Morgan Guide to the Markets talks about different asset classes over 20-year periods, and they use a Dow bar study to measure average investor success. So really what we want to focus on here is S&P 500 has been a big topic of conversation today. That's returned 6.1% annualized over the last 20 years, from 99 to 2019. The average investor during that same time frame has done 2.5%. So barely outpacing inflation, very important. And a lot of that has to do with that behavior gap, not necessarily looking at, the market in an objective lens, in a lens that says over the long term, I will be awarded for my discipline and my strategic asset allocation and not rewarded for my timing when I got in and out at the right times. Certainly there are people that get lucky doing that and that have done it effectively at different points in time. But over the long term, over a 20-year period of time, the data is showing us that the average investor hasn't had that experience. So it's important to understand what's right for you from an investment perspective, from a risk perspective, and ultimately understand that regardless of what's happening in the election, that will pass, and then the market will normalize itself to a point where it will price in the things that are important to it. And ultimately you will get a return reflective of that. So what's the bottom line? Evidence shows that you should vote for your candidate or candidates with the confidence that your portfolio doesn't really care who wins. I mean, it seems very simple to say, but that's the reality. The data shows us and the evidence shows us that vote for your candidates based on confidence that your portfolio is not going to really care who they are and who's going to win, because the market will adapt, and over the long term, the market will prevail. So I want to wrap it up there today. I'm going to bring Devin back in. He's going to talk a little bit about some of those resources that I mentioned. What we really want you guys to get out of this, guys and gals, is take a disciplined approach to investing. If you're working with us, please feel free to reach out to us at any time. That's what we're here for. We're here to help you through times like these. If you're not working with us, we encourage you to either reach out to us or reach out to someone else. Advisors can be great allies in times like this. They can be great coaches. And so we encourage people to do that and take advantage of the resources that are available to you. We're going to make some of those available. We're going to continue to do webinars like this in the future so that everyone can get something valuable out of it. So with that, I'll turn it over to Devin, and he'll bring us home.
Awesome. Thanks, Ryan. Great job. Great information today. So one of the resources that Ryan was talking about goes into analyzing your portfolio. Everybody has a risk tolerance, a risk number that they personally have, how much risk they want to take. But that number doesn't always match up to their actual portfolio and how they're actually invested. So if you're interested in seeing what your risk tolerance is compared to what your actual number is for your actual portfolio, let us know. We'd love to do it for you free of charge. It's very eye-opening sometimes. I think people are really fun, interactive way to look at your investments. But any questions at all, there's a lot of ways you can reach us. You can reach us at www.StatonWalsh.com. You can find us on social media, on Twitter, Facebook, and LinkedIn. Give us a call whenever. Our office line is 410-777-9487. And finally, our email is swinfo@StatonWalsh.com. Once again, thank you so much for tuning in today. We really appreciate your time. And to go out and vote, whoever it may be. Ryan gave great information today about how it doesn't really necessarily affect the portfolio that much. So just thank you so much, and talk to everybody soon.
Thanks, everybody.